Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome in this video. This video is a continuation of my previous two videos on a topic ratio analysis. In the first video, I have covered the first category of ratio analysis, namely liquidity ratios. In the second video, I have covered solvency ratios, which is second category of ratio analysis. In this video, I will talk about the third category of ratio analysis, namely profitability ratios. Viewers, profitability ratios measure a business ability to earn profits relative to their associated expenses. Recording a higher profitability ratio than in the previous financial reporting period shows that the business is improving financially. Profitability ratios can also be compared to a similar firm's ratio to determine how profitable the business is relative to its competitors. Some examples of important profitability ratios include gross profit margin, EBITDA margin, operating profit margin, net profit margin, return on asset, return on equity, and return on capital employed. So let's have a look at the most commonly used profitability ratios and their significance. Most companies refer to profitability ratios when analyzing business productivity by comparing income to sales, assets, and equity. Six of the most frequently used profitability ratios are: the first one is gross profit margin. Viewers, gross profit margin, when we talk about this ratio, so all margin ratios, the end result, it comes in percentage. So two things are common. In the denominator, whenever we calculate margin, so in the denominator, sales or revenue will come, and the numerator will be the ratio we are looking for, we are going to calculate. And since we are calculating margin, so obviously the end result we will have to multiply it by 100 to convert it into a percentage. So gross profit margin compares gross profit to sales revenue. A high gross profit margin ratio reflects a higher efficiency of core operations, meaning it can still cover operating expenses, fixed costs, dividends, and depreciation, while also providing net earnings to the business. On the other hand, a low profit margin indicates a high cost of goods sold, which can be attributed to adverse purchasing policies, low selling prices, low sales, stiff market competition, or wrong sales promotion policies. The second ratio under the profitability category is EBITDA TA margin, or in short, we can read it as EBITDA margin. So what does it stand for? So EBITDA stands for earning before interest, taxes, depreciation, and amortization. It represents the profitability of a company before taking into account non-operating items like interest and taxes, as well as non-cash items like depreciation and amortization. As its name suggests, that we are considering earning before interest, tax, depreciation, and amortization. The benefit of analyzing a company's EBITDA margin is that it is easy to compare it to other companies since it excludes expenses that may be volatile or somewhat discretionary. The downside of EBITDA margin is that it can be very different from net profit and actual cash flow generation, which are better indicators of companies' performance. EBITDA is widely used in many business valuation methods. A high EBITDA percentage means the company has fewer operating expenses and higher earnings, which shows that the company can pay its operating costs and still have a decent amount of revenue left over. So it means that the higher EBITDA percentage, it is good for the company. The EBITDA margin is a simple metric that can be calculated from the company's income statement to give an overview of the company's financial health. If you are comparing your company against competitors or industry averages, it's a handy metric that you can use to get a clearer picture of your operating performance. It is also likely to be a metric that investors use when deciding on whether to fund or acquire your company. So it's important to familiarize yourself with this margin and what it means for your overall profitability. The third ratio under the profitability category is operating profit margin. Operating profit refers to earning before interest and tax. As you can see, that operating profit margin, it looks at earnings as a percentage of sales before interest expense and income taxes are deducted. Companies with high operating profit margins are generally more well equipped to pay for fixed costs and interest on obligations, have better chances to survive an economic slowdown, and are more capable of offering lower prices than their competitors that have a lower profit margin. The fourth ratio under profitability category is net profit margin, and it's quite easy to understand that net profit margin, we have net profit divided by sales and multiply by 100. The net profit margin is the bottom line. It looks at the company's net income and divides it into total revenue. It provides the final picture of how profitable a company is after all expenses, including interest and taxes, have been taken into account. A reason to use the net profit margin as a measure of profitability is that it takes everything into account. A drawback of this metric is that it includes a lot of noise such as one-time expenses and gains, which makes it harder to compare a company's performance with its competitors. The fifth ratio under profitability category is cash flow margin. The formula is cash flow from operating activities divided by net sales. Cash flow margin, it expresses the relationship between cash flows from operating activities, the cash flow which business earns through its operations, and sales generated by the business. It measures the ability of the company to convert sales into cash. The higher the percentage of cash flow, the more cash available from sales to pay for suppliers, dividends, utilities, and service debt, as well as to purchase capital assets. Negative cash flow, however, means that even if the business is generating sales or profit, it may still be losing money. In the instance of a company with inadequate cash flow, the company may opt to borrow funds or to raise money through investors in order to keep operations going. Managing cash flow is critical to a company's success because always having adequate cash flow both minimizes expenses. Example, avoid late payment fees and extra interest expense, and enables a company to take advantage of any extra profit or growth opportunities that may arise. For example, the opportunity to purchase at a substantial discount the inventory of a competitor who goes out of business. The sixth ratio under profitability category is return on assets, and its formula is net income divided by average total assets. Return on assets as the name suggests, shows the percentage of net earnings relative to the company's total assets. The ROA ratio specifically reveals how much after-tax profit a company generates for every $1 of asset it holds. It also measures the asset intensity of a business. The lower the profit per dollar of asset, the more asset intensive a company is. If you look at the formula, if this ratio, if it comes low, it means that the company is more asset intensive. Highly asset intensive companies require big investments to purchase machinery and equipment in order to generate income. The example of industries that are typically very asset intensive include telecommunication services, car manufacturers, and railroads. An example of less asset intensive companies are advertising agencies and software companies. The seventh ratio under the profitability category is return on equity, and its formula is net income divided by shareholders' equity. In short, we can write it as ROE. It expresses the percentage of net income relative to stockholders' equity, or the rate of return on the money that equity investors have put into the business. The return on equity ratio is one that is particularly watched by stock analysts and investors. A favorably high return on equity ratio is often cited as a reason to purchase a company's stock. Companies with high return on equity are usually more capable of generating cash internally and therefore less dependent on debt financing. The eighth ratio under profitability category is return on investment or returns on invested capital. When we talk about capital invested, so it includes both types of capital, equity capital and debt capital. Return on invested capital is a measure of return generated by all providers of capital, including both bondholders and shareholders. It is similar to the ROE ratio, but more all-encompassing in its scope since it includes returns generated from capital supplied by bondholders. The simplified return on invested capital formula can be calculated as earning before interest and tax multiplied by 1 minus tax rate divided by value of debt plus value of equity. When we talk about capital, so it includes value of debt, long-term debt plus value of equity. Earning before interest and tax is used because it represents income generated before subtracting interest expenses and therefore represents earnings that are available to all investors, not just to shareholders. Viewers, this was the discussion on different types of ratios that comes under the profitability category. I've already explained these ratios one by one, which comes under profitability categories, including their formulas and interpretation. In my next video, I will talk about efficiency ratios. So viewers, thank you for watching this video. Do subscribe to Finance Specialist channel by clicking on subscribe button at the right bottom of this video and hit the bell icon to get the intimation of my upcoming video on efficiency, coverage ratios and market prospect ratios. Thank you very much. Stay blessed. See you in the next video.